Hello and welcome to the Stockout. The Stockout is your show at Freightways for all things related to the consumer packaged goods, the CPG industry, and their supply chains. I'm your host, Mike Bowden-Distel. I'm the head of Intermodal Solutions here at Freightwaves. And what we do with this show is we set aside 26 minutes to go through what's happening in the world of CPG, try to make this relevant to any CPG companies out there that are involved with the company's supply chain or carriers that service the CPG companies or intermediaries that may work with brokers or that may work with carriers or shippers or anyone out there that's just kind of sort of interested in what's happening in the consumer space, which really says a lot about what's happening in the overall economy. So a lot to talk about today. It seems like the more problems there are in CPG supply chains, the more material that gives me to talk about on this show. And today I'll talk a little bit about some of the big CPG giants that reported this week. We had Kraft Heinz, Keurig, Dr. Pepper, Unilever, all said things I thought were pretty interesting about their supply chains. I'll also talk a little bit about how travel patterns are changing and how that can impact CPG supply chains. We started to see some of that, and to the extent that there's time, I can also give an update on the rail industry, something I follow very closely here at Freightwaves. But before I do that, just give a little bit of a shout out here to our sponsor, RJW Logistics Group. RJW owns and operates every step of the middle mile. As an asset-based integrated logistics company, they offer a full suite of retail supply chain solutions under one roof, including industry-leading retail consolidation that consistently delivers over 98% on time and in full, month after month to many retailers. RJW's programs offer global suppliers control and transparency, helping them improve in-stocks, achieve retailer compliance, grow market share, and increase sales. Visit rjwgroup.com to optimize your supply chain today. So big thanks to RJW Logistics Group. Did talk to their CEO, Kevin Williamson, on the previous episode of the Stockout. He had some interesting thoughts to share on warehousing space and has a thesis that the warehousing prices are maybe about as high as they're going to go. And I think they would know they really are involved heavily in that market in the Chicago area. So the first topic I want to get into here is how supply chains are impacting Kraft Heinz market share. You have a stock chart there that shows us how they've actually performed pretty well. I mean, you sort of see that the stock charts for Kraft Heinz, they're above pre-pandemic levels. Really, the CPG industry during the pandemic really has stood out. It seems like there's been a preference for some of these national brands, preference for certain brands that brought people back to their childhood. And Kraft Heinz, market share, they said that they're gaining market share in most of their product categories, and maybe the exception to those are where their supply chains are constrained. It was a little bit of an odd quarter for Kraft Heinz because they negatively pre-announced a month or so ago, and then they, only to beat expectations when they actually reported. That doesn't happen very often, which the company attributed to demand that held up better than they were anticipating, and that was really a function of just elasticities being fairly low. I think most CPG companies have been sort of favorably surprised by how low elasticities are. They've all raised prices significantly to deal with the input cost inflation, and consumer behavior has been relatively unchanged. So those have been positive impacts for Kraft Heinz. And you sort of go through the various segments. They say about 80% of their supply chain challenges are upstream, which they include as ingredients and packaging materials. And I thought this really was an interesting quote that they said that at any point in time, there's one thing or another that they're short on, either some ingredient or some piece of packaging material that they don't have that's inhibiting them from getting all the products on shelves that they want to get on shelves. They said their on-shelf percentage is in the low 90% range, which is better than it was a year ago, but still not where they want it to be. And you sort of look at some of their individual segment categories, areas where that don't have supply chain constraints and really hadn't had supply chain constraints. They're gaining market share 80 to 90 basis points. Those would be things like condiments and sandwich cheese, which they're, of course, very big on, those sort of name flagship products. Other areas where they had previous supply chain constraints, and some of those have been alleviated, they're really taking a lot of share in sort of this 100 to 200 basis point range. Those would include things like Lunchables and children's single-serving beverages. So taking a lot of share there and actually losing a significant amount of share where there are capacity constraints. And where there are capacity constraints or supply chain constraints, I should say, are in areas of kids, snacks, and appetizers. They said their market share there declined 180 basis points. In powdered beverages, they said their market share declined 260 basis points in that category. So really, it's sort of the market share changes really a function of supply chain constraints or lack thereof. Seen that with other CPGs as well, where it does appear last few quarters, General Mills has taken share from Kellogg because Kellogg has been more capacity constrained with some of the supply chain issues. And I think sort of the implication is that if Kraft Heinz can get some of these supply chain issues straightened out, they'll take share across the board, and the consumers are demonstrating a preference for their products rather than private label. They've talked about how the gap between their prices and private label has actually narrowed a little bit, so there's a little bit less incentive to go for that cheaper private label option in their categories. Some of the other interesting takeaways from Kraft Heinz this quarter is they said at their European factories, they've installed power generators to preserve power continuity in the case of a power disruption from a potential natural gas shortage. The natural gas situation is really fluid. The prices were really high. Now they've sort of fallen apart. Not sure how the winter is going to progress, but they're hedging against that, and also seem to be hedging against the potential impact of a carbon dioxide shortage. We've talked about this CO2 shortage on previous calls here, stock out calls, and really what they're trying to do is recapture and recycle CO2, and so they can reuse that back in the process. So that seems like it's huge for their environmental initiatives, in addition to just hedging against the supply chain disruption. Also said they're investing a lot in factory automation, which I think is really going to be a big trend in CPG. They've had so many labor issues that really have exceeded past cycles. You think about companies like Tyson that have had a hard time getting people in the meatpacking plants. Companies like Kellogg that had a big strike. I think that to the extent they can automate those, that can really be helpful to keep products on shelf. So I think automation is a trend to watch here. And then really rationalizing SKUs is a trend to watch throughout CPG, and Kraft Heinz is doing that. They said in the third quarter, their SKU count down 2% year over year. I think the idea is you get rid of the lower performing SKUs, and if you're a big CPG, you usually have other products elsewhere that those customers that typically buy those SKUs will gravitate towards. So the big CPG have an advantage with the SKU changes. So a lot going on with Kraft Heinz supply chain, and I'll move on to the next topic here. A lot going on with the Keurig Dr. Pepper supply chain as well. Keurig Dr. Pepper calls out logistics challenges. I have a stock chart there that shows that they're nicely ahead of pre-pandemic levels. I think they've had some success with some of their newer product lines, things like Bai and Core beverages. They do say that supply chain challenges continue to impact volume of certain product lines, including Snapple, Bai, and Core. But they've seen improvement in the Snapple product line of late. Previously, they had been struggling with packaging constraints, including finding enough glass for Snapple beverages, which typically come in glass. They had to use more plastics, but those constraints are largely behind the company. No word on whether they've had enough, have any supply chain issues with the caps that make all those noise when you press it down. Didn't say anything about that. There was this really interesting quote from Keurig Dr. Pepper. I want to read this. This is from Robert J. Gamgort, the chairman and CEO. He says, our bigger challenge, and I think consistent with the industry, is actually transportation right now. Customer pickups as well as shipments that we make are not through our own fleet are increasingly challenged, where those pickups don't happen as scheduled and transportation is unreliable and incredibly costly. So he's saying that when they're not using their own fleet, the for-hire service is just not very good, which is kind of an interesting comment given where tender rejections are. We can put the tender rejections chart on the screen. We talk about this all the time on FreightWaves TV. but the tender rejection index has been down to, there you see it, down to 4.34%. And remarkably, now it's below 2019 levels, which was a year that was characterized by companies going bankrupt like Celadon and a number of others. And really sort of is an indicator that carriers are accepting most loads. Shippers shouldn't have a hard time getting coverage. Keurig Dr. Pepper seems to be a little bit of an exception there, and I can speculate as to why. I don't know exactly why, but you look at their 10K, and they have a leased or owned fleet of 6,300 vehicles in the U.S., 1,700 in Mexico, and so when you have a private fleet that large, some of the for-hire carriers can look at that and say, well, that's not a great account, because as soon as their volume starts to dip down, they're going to put the capacity in their own trucks. We're going to lose any volume, and we're going to have to find a way to get those trucks filled. And then there are just other reasons why a particular CPG company might not be a preferred shipper. One of those reasons is just taking too long to pay carriers. There's some shippers that could take 6 months to pay a broker, kind of using that broker like a bank, and then the bank has to pay the carrier capacity, but while they're sort of floating the money to the shipper, that's the type of thing that causes brokers and carriers to not want to deal, with a particular shipper. I'm not saying that happened, but that's something that we've seen, in the past at FreightWaves. Or the other thing that often happens is sometimes a shipper not giving the carrier the volume that it promised them it would give it, so it didn't just get the volume. And sort of not doing what you say you're going to do. So sometimes that's an issue too. But we'll see if they have similar comments on their next earnings call. To topic number 3 here, I did think Keurig Dr. Pepper had an interesting idea on supply chain as far as how consumers can never run out of coffee. And I think this is interesting because it could really change how coffee is delivered if this is a trend that catches on. So some of these newer Keurig machines, we all know the Keurig machines, you put the K-cup in, you do it, and you have a single serving beverage. The newer machines are connected to the internet and reads the products like SKU, kind of barcode, knows exactly how much you're drinking, knows exactly what your rate of consumption is. If you have a household that has multiple coffee drinkers in there, it sort of knows how much you typically consume by SKU a particular week, and you can sign up to have the coffee automatically refilled based on your current consumption patterns. So you can never run out of coffee unless there's something just very unusual about your consumption patterns. You have a lot of people over or something, maybe you run out, but under normal circumstances you never could. So it's a type of situation too where it's going to save the preferences of the individuals that use the K-cup, so they know exactly how you take the coffee, can prepare how you like it. So it's a type of thing where this catches on. Maybe people stop buying coffee at the grocery store. They have it all delivered. It's one thing that I think is really seems like it would make for customer stickiness with K-cups. Find this pretty interesting. We've long heard about smart appliances like having your refrigerator connected to the internet, so I know how much milk you have and all these things. But I think those things are further out, whereas just having your coffee maker connected to the internet could really change how you consume coffee. So with that, take a little bit of a break from CPG news to give another shout out to RJW Logistics Group for sponsoring this show. Are you assessing the advantages of prepaid versus collect freight management for delivery into retail? RJW's retail consolidation program consistently delivers over 98% on time and in full to ensure a stronger shelf presence, increased in-stocks, retailer compliance, and overall retail supply chain improvement. Visit rjwgroup.com to speak with our retail logistics expert about the advantages of RJW's program and to make the best decisions for your business. So thanks again to RJW Logistics Group. We did have a show with them, not the most recent one, but sort of a number of shows ago. He had Kevin Williamson on, and we talked about how the CPG companies can eliminate those fees for not having in full to the retailer. So those can be a pretty big deal as the retailers increase fees for those issues. Topic number 4 here. Go to a company we're all familiar with. Unilever is achieving strong in stocks. That was kind of the thing that stood out to me, where they said that their on-shelf availability is about 96%. So certainly higher than what I was just talking about with Kraft Heinz. And they gave some detail on elasticity too. They said overall their volume dropped 1.6% on price increases of 12.5%. That's worldwide. And I think that's pretty good relative to historical levels. If you can take prices up that much and just lose a small amount of volume, I think you're in pretty good shape. Volumes in Europe dropped 3.2%, so about double what they did worldwide on pricing that was up 8.9%. So higher elasticities in Europe. I think we're all familiar with the European exchange rate being worse, and just inflation overall being higher in Europe, taking a bigger bite out of the European consumers' budgets. There was one sort of interesting stat I saw on groceries in Germany are up 18.7% year over year. So just real bad inflation there, in Europe, and that one really just drove it home. You can sort of compare that in the U.S. It's more like 13 to 14%, which isn't great, but better than it is in Europe. When you look at Unilever's global mix, Europe is about 20% of sales, North America is about 20% of sales, and then 60% is outside of Europe and North America. And it was interesting that they said that those markets right at the moment are more resilient to rising prices. So that was something that maybe I wouldn't have expected, that those a lot of those emerging markets being a little bit more resilient than they are than the U.S. sales. They did say that private label penetration is taking a little bit of a bite out of sales in ice cream and household care. They said, they also gave a couple of examples of how to prevent supply chain collapse. And a good quote there from the company's management that said, there is a surefire way to guarantee a supply chain collapse in CPG, and that is to have all your sort of eggs in one basket in terms of having your suppliers concentrated in one country. And they gave an example of how they have suppliers that are redundant in China and India. And when there were the lockdowns in China, they used some of the Indian suppliers for certain components, and then they went back to the Chinese suppliers after those lockdowns, came to an end. And they've also talked about how they're kind of punching below their weight class in Indonesia, because Indonesia is vertically integrated. They're the biggest supplier, them in the Philippines, of palm oil, which palm oil goes into a lot of these personal care products. And so it's hard to compete in Indonesia with companies that are Indonesian companies, because they buy well they buy palm oil very well. So I thought it was an interesting point of commentary there. So I'll move on from Unilever and talk about travel patterns in the U.S. And I think these are interesting, and they certainly have an impact on CPG demand, and it maybe goes to what I was talking about earlier about how CPG companies can mitigate the impacts of volatility in sales by having more automation. But the travel patterns are a lot different. So this summer, tons of leisure travel. You probably noticed that if you spend any time at all at an airport, full of people in casual clothes, going on vacation. And the airlines were really worried that once fall hit and kids were back at school, that travel would really drop off, that business travel would not pick up the slack like it usually does. And that hasn't happened. Business travel is still depressed, but the casual travel still in full force. Seems to be a function of, maybe it's the strong dollar, maybe it's also these hybrid work schedules. Allow any weekend to be a 3 or 4 day weekend if you plan your work schedule correctly. Maybe it's also just sort of making up for lost time without not a lot of travel during the COVID, but for whatever reason, a lot more travel this fall. Leisure travel this fall has disrupted some CPG patterns, and it's good for some and bad for others. It's good for the sort of energy on the go market. You think of Mondelez's ownership of Cliff Bar; those tend to do well when people are out and about. Coca-Cola does well when consumers are out, because a lot of the restaurants only have Coke products, so their market share is higher in food service than it is in retail. That's more competitive. And then there's an interesting comment from L'Oreal, which they were concerned with demand in July in the U.S. And later walked that back and said, well, we think that was a false alarm and was really largely from Americans visiting Europe, taking advantage of the exchange rate. They weren't at home buying a lot of cosmetics. And when they returned in the fall, they bought more cosmetics, and it was just kind of a false alarm. So I thought that was interesting. A company that would have maybe have a negative impact from more travel would be a company like General Mills, which is really strong in the at-home channel and performed really well when everyone was at home and buying more things for breakfast at home. So it's something to keep an eye on are these changing travel patterns. We'll see how long that persists. I also want to read just a sort of a quick one-liner from CPG on CPG packaging. This was from a Wall Street Journal article on Hershey's expansion of salty snacks. Recall they bought Dots, which is a pretzel company. Seem to be really happy with the acquisition. Talking about their packaging, they said also the invention of the resealable packaging. For the 8 people on Earth who can resist crushing a bag of Reese's peanut butter cups in one sitting. So a CPG trend, trying to make the packaging more environmentally friendly by making it resealable. I think consumers like that, but for certain products, I don't know how anyone can avoid eating it in one sitting. Certainly, Reese's peanut butter cups would fit in that category. So that was a great quote. Got about 4 minutes left. I'll give just a brief update on the rail industry. Norfolk Southern reported, yesterday. They seem to be in the midst of doing a lot of hiring, a lot of training, like the other Class 1 railroads are. Most of the Class 1 railroads have blamed all these service issues on hiring. Norfolk Southern says, first we need to get the employees hired and trained. That will lead to improvements in service levels, and those improvements in service levels will lead to volume improvement in areas like intermodal, which is competitive in their region. They operate in the eastern 1/3 of the country, let's say from Chicago, eastward for the most part, and very competitive in those lanes. We've seen a lot of intense competition across modes between truckload and intermodal in that Chicago to Atlanta lane, for instance. But still, volume challenges. They called out volume challenges specifically in international intermodal, where typically they would move more international intermodal, let's say inland from the port of Savannah, which we can look at our data in Sonar and see that that's really an international corridor, international intermodal corridor. The 40-foot containers, and those volumes have been volatile, and they attribute that to just competition with truck and chassis shortage and some congestion at the inland terminals, where they didn't want to send those containers inland for fear that they would take too long to get back. There was one analyst question that I thought they really dodged, where they were asked whether the weak truckload market is going to have an impact on domestic intermodal contracts in this upcoming year. And the management just sort of said, well, we'll price this to the market, and gave kind of a non-answer. And I think the answer really is yes. I think the domestic intermodal contracts, it's going to have a hard time pricing those contracts higher, particularly in the areas that's competitive with truck, given that this looseness in truckload seems like it's going to be here to stay and is going to be pretty intense here in the coming months. There's also this interesting question in the railroad industry as to whether or not the railroad's cost structure has become less flexible. So historically, the railroad volume with the economy, it goes up and down. And when the volume goes down, when there's an economic period of slowness, they can pretty easily, historically, they've easily been able to cut workers, furlough workers. Those guys go to do construction. They do something else in the interim to stay busy. And then when the volumes return, they're happy to come back to the railroad. And it's really been different this time, where they have not been as willing to come back to the railroads, and the railroads have had to hire people that are new to the railroading industry and train them. It does take anywhere from 4 to 6 months to train a new railroad worker. There's so many safety protocols that need to be followed because it's such a dangerous profession if you make a mistake. So really, the railroads are still in the process of training employees. They're ramping up there, and it calls into question whether in the future they will be able to cut and furlough those workers, because it's had such an impact on their service levels that if they do that, the Surface Transportation Board could really come down hard on them. So they might have to have a sort of a permanently higher level of resources. But I think that's really a big question, in the railroad industry, and I'm sure one that the employees are asking themselves as they take those jobs. So, with that, hope everyone is having a good Halloween, which is when this goes live. And for those who are not signed up for my newsletter yet, please go to www.freightwaves.com/the stockout and sign up for my newsletter, the Stockout. I try to get 2 of those out every week and go through topics like these, whatever I think is interesting in the world of CPG, supply chains, transportation markets. And if anyone needs anything from me, feel free to reach out at mbowdendistel@freightwaves.com.